Hello, welcome to Managerial Accounting. This is going to be Chapter 13 lecture. We are going to start out by talking about how we will analyze the financial statements. So let's just go ahead and jump right into this. If I can get it to go past the first slide here. There we go. All right, what is the purpose of managerial accounting? Before this, you've learned about financial accounting. You've learned all about creating the financial statements, the balance sheet, the income statement, the statement of cash flows, and so much more. So the main idea of financial accounting is going to be for the external users. The managerial accounting is for the internal users. So this helps all of those decision makers inside the company to make good decisions and to improve efficiency and effectiveness. So we're going to be analyzing all of the financial statement information on a managerial perspective. Like I said, the financial accounting is for the external users, for investors and lenders. That's who is going to be looking at the external, at the financial accounting information. This whole semester we'll be focusing on the internal users, the managers, and any officers who are trying to make decisions to help the company to be more efficient. So we have a few different ways to analyze. One thing we're going to look at is liquidity and efficiency. This is all looking at our short-term assets and liabilities. So liquidity, I know you've heard this word before, that is how quickly we can pay down our current liabilities with our current assets. How well can we do that? And we're going to look at some ways to analyze that. Efficiency is how well are we using those short-term assets. And then we have solvency. So there we are talking about being able to pay our long-term liabilities with our finances, with our assets. Profitability, I'm sure you're familiar with that. We know that the income statement helps us to understand how profitable a company is. So that's something that's always very important with a business. Then we have our market prospects. This has to do with how does the market view our company? How much do they see it as being worth? What kind of reputation does our company have, and what kind of prospects do we have financially for that reason? You should be familiar with these general purpose financial statements, the income statement where we see that profitability, we see the net income after we have all of our revenue that came in, and we basically subtract all of our expenses and losses. The balance sheet, that gives us a moment in time. This is our statement of financial position. This tells us how much we have in assets and who has a claim on those assets. Are they liabilities where we owe our lenders or creditors, or is it going to be owner's equity where the shareholders or the owners have ownership of those assets? Then we have this statement of stockholders' equity that breaks down the equity section of the balance sheet. The statement of cash flows, it can be similar to the income statement, but it's not just looking at revenue and expenses. It's looking at actual cash coming in and out. Not every revenue or expense is going to reflect cash coming in or out in that same period. And then we have the notes to the financial statement. So anything that wasn't included in there that we find to be important information, we are going to put in the notes. We know that the reader is going to need to see some other information. So first we want to look at some standards for comparisons. We could also call these benchmarks. So we are going to cover how do we compare our information. And one way to compare it is the intra-company. So this is where the company is comparing their current performance to a prior performance. Maybe they're comparing it to several years prior, maybe to just the year before, maybe the quarter before, but they are comparing it within their own financial statements. Or they can compare that to a competitor. Okay, so we sell cell phones, and so does this other company. How do we do compared to them? Then we have the industry. Okay, so maybe we are in the industry of selling electronics. How are other companies doing right now that sell electronics? Maybe we're in some kind of entertainment industry. Maybe we are a movie theater, or we are a we are like Roku or Netflix. We can compare to other people who maybe are not our direct competitor, but how are we doing compared to other people in the same industry? How's Disney Plus doing compared to the movie theaters? Then there's guidelines, which is basically the experience. From our experience, we see that our sales are typically down in January and they go back up by the end of March, whatever. So that would be a good example of a guideline or experience. That's something that we would compare it to. So what are some different tools we can use to analyze the financial statements, to do all of these different comparisons? First, we have a horizontal analysis. So think about the horizon, horizontal. I always think about the horizon when I think of, is it vertical or horizontal? So horizontal, we're going to be comparing from one time period to another. So if you think about it, it's going to be across the board, and we're going to look at some examples. So it's going to be in a horizontal line. You're comparing numbers from one period to another, comparing it across time. Then there's vertical, so up and down. The vertical analysis is a little bit different. Here we're going to be comparing the different accounts, the different line items to a base amount. Again, we'll look at an example, but this is going to be different. We're not comparing things over time. We are comparing things all in the same period to each other. Then we have our ratio analysis. Ratios really can come in handy. This helps us to figure out measurements between different financial items, even if those financial items, let's say we're comparing our small town cell phone shop to the Apple store. Well, it's hard to compare ourselves to that. But if we use ratio analysis, it can really help us to compare and see how we're doing, even compared to the big box companies. All right, so first we're going to look at, we have a few formulas in here. We're going to look at a dollar change. Okay, so for the dollar change formula, it's going to be the analysis period amount minus the base period amount. So the analysis period is usually your current year. It's whatever financial statements that you are trying to analyze compared to the base period. So I want to see how we did in 2021 compared to 2020. And that would be the analysis period compared to the base period. The base is what we're comparing it to. The analysis period is typically the most recent period that we want to see how we did compared to the base period. So here we're just finding the dollar change. So in 2021, we made $2 million. In 2020, we made $1.8 million. So we have $200,000 difference. That's the dollar change. Very similar to that, we have the same definitions here for analysis period and base period. So very similar, we have the percent change. So here we're not looking for the dollar amount, we're looking for the percentage change. So what we're going to do is take the analysis period amount, typically our current period, the one that just closed, minus our base period amount, and then we're going to divide it by the base period amount. And to change that from a decimal to a percentage, we're going to multiply it by 100. So that's what we would do for the percent changes. Hopefully you like formulas. There are a good bit of formulas in this class. So I like to show some examples of homework problems as we go through the chapters. So this is an example of one right now. So we're doing a horizontal analysis. We are comparing from one year, from one time period to another. So this is what your question would look like, and we have to fill it in. So for our percentage change, what's the numerator? We just looked at that. It's going to be the current year or the analysis year minus the base year. And then we're going to divide that by the denominator. So we're dividing it by, what was the denominator? It was simply the base period, the base year, the amount they made them. So that's our formula. And down here we have three different line items. We have short-term investments, accounts receivable, and notes payable. And then we have the dollar number for the current year compared to the prior year. So we'll just fill those numbers in. So we take the current year amount, the $375,686, minus the prior year, this $234, divided by the base period. And that will first give us, if we just take the current year minus the prior year, that'll give us our dollar change. Then we divide it by the base period, multiply it by 100 to get our percentage change. So we're going to do that for each one. So for the accounts receivable, we took the current year amount minus the prior year. That gave us a dollar change. Our accounts receivable went down this year, so it gives us a negative $3,324. When we divide that by the base period, we divide it by the 102. That gives us a percentage change of a negative 3.25%. And again, this would have come out to be 0.0325, but if you multiply it by 100, it will give you the percentage. The notes payable is a little different. We don't have any notes payable in the current year. We paid it off. So we take 0 minus the prior year, 89,147. So that's going to give us the negative 89,147. Then we divide it by itself, and it's going to give us 100% change. We paid 100% of it off, so that makes sense. So that's what one of your homework problems would look like. Let's look at another homework example. In the current year, Dunder Mifflin reported net income of $56,000, which was a 12% increase over prior period net income. Compute the prior year net income. Okay, so they had net income of $56,000. That's 12% more than they did last period. So what did they do last period? So what we're going to do here is we're going to take the $56,000 divided by 1.12. So that's 112%. So this right here, the 56,000 is 112% of whatever we did in the prior year. So it was all of this plus another 12%. So we're going to take 56,000 divided by 112%. That would give us what we did in the prior year, 50,000. If you're like, okay, I'm not sure if that made sense, not sure if I got the right answer there, another way you could do it is once you get the answer, once you get that 50,000, multiply the 50,000 times 1.12 because they did 12% more. They did 100% of this plus another 12%. They did 112%. So you could take 50,000 times 1.12, and that would bring you back to that 56,000. Let me know if you have questions on that. All right, so let's look at comparative balance sheet. So here, this is going to be a horizontal, remember we're going across like a horizon analysis. So here we're comparing the dollar change, just like we did in that problem. We're going to take the current year and subtract out the prior year, and that's going to give us $195 negative dollar change. So we have $195 or $1 million actually, less than we did last year at this time. And then if we divide that amount by the prior year, it tells us it was a 1% negative change. Doesn't seem like a huge deal. I wouldn't be too alarmed. But you want to go through and do that to each line. The current year minus the prior year, that gives us our dollar change. We're using that same formula we did first. Then when we divide it by the prior year, that gives us the percent change. When you come through here and you compare it, what you're probably going to be looking for is either a large dollar change and or a large percent change. For some companies, a dollar change of $10,000 might be a lot. That might be a material amount, an amount that matters. For other companies, they're going to say, oh, it has to be at least $1 million to even matter to us. So it all depends on how large of a company it is, but they're going to go down through here and say, okay, are there any alarming amounts? So let's see, we've got inventory was $2 billion, because this is in millions, $2,723,000,000 more than the prior year. Okay, that seems a little concerning. Is that good? Is that bad? Okay, well, what they want to do, it's 127% higher than last year. So what they want to do is say, why? Why do we have so much more in inventory? Maybe there's a super rational reason for that. Maybe we have a very concerning reason for that. Maybe we stocked up on something and then COVID hit and nobody wanted that product anymore. So now it's all just sitting there. Or maybe we know that we're about to have a really big sell on that item, and so we wanted to really stock up. So that's something you want to look into. So you would just go through that way and compare it from one period to the other. And then if we look at liabilities and stockholders' equity, we do the same thing. We took the current year minus the prior year. That gave us the dollar change. And then when we divide the dollar change by the prior year, that gives us the percent change. Again, accounts payable here has gone up 31.5%. So we owe a lot more at this time than we did at this time last year. So why is that? Why do we owe our suppliers so much more? Well, we already saw the inventory was way higher, so that could be one reason. But what's the purpose for that? So you would want to look it up and see what the big change is. If you see current portion of long-term debt has gone up 85.5%. That's a lot. So why is that? Well, maybe you had some really big debt that has been leading up to this point, and now it's coming due. So it makes sense that would roll over. All right, and that was for the balance sheet. Now let's look at the income statement. So how do we look at the comparison here in the income statement? We have the current year minus the prior year. That gives us the dollar change, just like before, just like the balance sheet. And then if we want to find the percent change, we take that dollar change divided by the prior year, and that tells us the percent change. So it looks like our sales, our net sales have gone up 6.3% from last year. So that sounds good. Might want to look into it. Why was that? Did we expect it to be a 10% increase? If so, then maybe that's not so good. If not, then maybe we're excited about it. Also notice the cost of sales went up 7.5%. So more than 1% more than the net sales. So our cost of sales have increased for some reason, higher than our sales themselves. Are we using a higher quality product? What is the reason for that increasing so much? So that would be something to question as well. So we just would go down through here. Okay, other income went up by 103%. So we want to research that. And then you see some things that you're like, oh, they don't really 0.3% for income taxes, not a big deal. You just want to look for anything alarming, and that's when you would research what's going on here. Then we have trend analysis. Trend analysis is going to show a pattern, not just from the current period to last year to the last period. This is going to be across several periods. So our trend percent is going to be the analysis period, very similar here, divided by the base period amount. That's going to give us a decimal. When we multiply it by 100, that's going to change it to a percentage. So again, trend percent will be the analysis period divided by the base period amount. So let's look at an example. Here we've got 3 different accounts that we're going to look at. We've got net sales, cost of sales, and operating expenses. So other things that were not part of the cost of making the goods. So we have our current year, then we have 1 year ago, 2 years ago, 3 years ago, and 4 years ago. So in this case, our base amount is going to be the latest, the oldest period. That was 4 years ago. So we are going to use 4 years ago as our base amount. So whenever we take each of these years, we're going to compare them to 4 years ago each time. So let's see how that looks. We ultimately came up with the percentage change here, not the dollar change. So the first time, 4 years ago, it's going to be 100% because we're going to take the analysis period, 170,000, divided by the base period, which was 170,000, and same thing for each of these. So for the base year, it will always be 100%. You're comparing it to itself. But then we move over to 3 years ago. Okay, 3 years ago, we made 182,000 in net sales. We divide it by the base period. That gives us 107%. So in other words, we made all of the same that we did last year, plus another 7%. Okay, sounds like we did pretty good. 2 years ago, we take our net sales, 233, divided by the 170. We're still using the same base year. Here we have 137 almost percent. Wow, we really jumped up. Last year we went up 7%. Now we went up another 30%. That's impressive. All right, then 1 year ago, we're going to take that 215,639 divided by our base year, again 4 years ago, 170,910, multiply it by 100 to make it a percentage, and we get 126%. 126% is good, but why did it go down from 2 years ago? That's interesting. So that would be something I'd look into. And then the current year, we're going to take the 229 divided by the 170 from 4 years ago. It tells us we have 134%. So it seems like most years we went up a pretty decent amount, but 2 years ago we really jumped up, and I'm wondering why that was. And we can do that. We'll do the same thing for cost of sales. We would take 3 years ago the 112 divided by the 106. That would give us 105. Okay, so our sales increased, our cost of sales increased, but not by too much more. I mean, a little bit less than our sales. So it sounds like we had a bigger gross margin. Our operating expenses, where we took the 18,000 divided by our base year by the 15,000, the operating expenses went up 117%, an extra 10%. Did we have to hire on another manager or something in order to handle that kind of sales? What caused that extra 10% compared to the other two line items? That would be something to look into. And again, if we look at 2 years ago, okay, we had the net sales went up by 136% of our base period. Cost of sales went up 131%, so a big jump also. And then operating, wow, went up an extra 10%. It went up 46% compared to the base period. So again, our operating expenses have just been going sky high. Then they all dropped back down a little bit in year one, 1 year ago, except for operating expense. It kept rising. So by the time we get to the current year, our operating expense is nearing twice as much as it was 4 years ago, when our net sales has only gone up by 34%. Something major is happening. Are we having to hire a new manager every time we increase our sales a little bit? Are we having to open a new building every time? What is the huge increase in operating expenses? We're not going to look into what that is right now, but it's just showing you how to read these financials and really look at it and say, okay, that's odd. We would have to look into that farther. So those were all horizontal. Those were all comparing one period to another. Now let's look at the vertical. We're going up and down here. So we have a new formula to look at. So that's going to be the common size percent. Common size is another way to talk about vertical analysis. It's the same idea. It's the same meaning, basically. So vertical analysis and common size analysis means you're looking at it in a vertical way. So again, we'll just take the analysis amount divided by the base amount. That gives us the decimal. And then if we want to find the percentage, which we do, we multiply it by 100. So same formula, but we're going to have a different base. It's going to be an account, not a period this time. So what we're going to do is, if we're looking at the balance sheet, we're typically going to compare all of our assets. So first, let's look at the current year. We're going to compare all of our assets to the total assets. Okay, so all the assets put together. What we're trying to see here is how much of our total assets is made up of cash. How much of our total assets is made up of property, plant, and equipment. So we have all these assets, which is a good thing, but how much of those is made up of each of these line items? And then if we want, we can also use some of our horizontal analysis and compare our current year to prior year. So the way we're going to do this is we're going to take our analysis amount. So let's do cash divided by the base amount. Remember, we said our base amount is our total assets. So our 20,289 divided by the 375,319, that would give us our 5.4%. And we do that for each one. The short term, we got 53,892 divided by, again, that base amount. That gives us 14.4%. We do that for each one of these all the way down. Each one of these numbers divided by the total assets, that gives us our percentages here. We can do the same thing for the prior year. Cash divided by total assets, 6.4. Short-term divided by total, that gives us 14.5. So we would just do that all the way down. Then we can look at if we want to compare the 2 years. Okay, so this year our cash is 5.5% of our total assets. Last year it was 6.5%. Was that intentional? Why did that change? Looks like short term was about the same. Accounts receivable is about the same. Inventories went up a little bit. The other two are about the same. Do we see any big changes? Really, we don't see any major changes here. And ultimately, you always want to make sure if you add up all your percentages that it does total 100%. All right, and then if we looked at you could do the same thing with liabilities, but we're going to move over to the income statement. So for the income statement, we're going to kind of flip it. Our base amount, I know it says base, but it's actually going to be the top. It's going to be the net sales. So from all those sales that we made, well, that's a great number, right? $229 billion. But where did all of it go? How much of it ended up being net income versus the cost of earning that income? So we're going to take each line item, cost of sales, gross margin, research and development, and we divide each one of those by the net sales, which is our base amount. So we take our cost of sales divided by our net sales. 61.5% of our sales went to the cost of making that product. So we do that for each one. Selling and administrative divided by net sales, 6.5% of our sales had to go to selling and administrative expenses. We go on and do that. And we could do it for the prior year as well. We could compare them. Looks like they stayed about the same. It went up a little bit, about less than 1% of cost of sales, which made our gross margin go down. Research and development went up slightly. Do we see anything alarming? Really, we don't see anything major. Ultimately, our net income ended up being 21% of our net sales this year and last year. So, hey, we're making 21% net income after everything is paid. So, sounds like we stay the same the last 2 years. Is that great? Is that bad? Really depends on the industry that you're in. This might be wonderful. It might be exactly what's expected, or it might be terrible. Just depends on what your industry is. This is the same concept right here. It's just taking the whole pie is the net sales, and then it's breaking out. It's just a different way of looking at it. It's breaking out the net sales. Okay, cost of sales was 61%. So the large majority of my sales went to making the product. Then my net income, here it's a little bit different, but it was about 20%. So that's a good thing. That orange one's what you want. All right, we paid some in taxes, research and development. So this is just another way to look at it. And so looking at it in that vertical way, you can make a pie chart out of it. All right, let's look at a homework example. It says express the items in a common size percentages. What does that mean? What does common size mean? Vertical, right? So we're just going to take each item, each line item. This is the balance sheet amount. These are all assets, and we're going to divide them by the total assets. So when we do that, we take 12,200 divided by the 237,700, we get 5.1%. For the prior year, we take the 15,400 divided by the total assets, gives us 8.9. And we do that all the way down, always using the total assets as our base amount. That's how you'd answer that homework problem. All right, liquidity and efficiency. So these are some different ratios that we can use in order to measure liquidity and efficiency. Remember, we're talking about our short-term, our current assets and liabilities. All right, I clearly made some little sound effects on those slides. So let's look at our ratio analysis. So first of all, how can we measure liquidity? The quickest one, the easiest one here, the easiest formula is our working capital. Working capital is kind of what's the cash I've got and what can I do with it? That's going to be your current assets minus your current liabilities. More working capital suggests strong liquidity. So if you think about it, if you have $10,000 in the bank and all of your short-term expenses, all your current expenses that you're going to have to pay total $7,000. Okay, I have $3,000 left over. So that's a good thing. If you had $5,000 in the bank and you had $5,000 in expenses, well, that's zero. I'm not leaving any wiggle room. That's not a good thing. The current ratio takes the same numbers, except it takes the current assets divided by the current liability. That gives you the current ratio. That basically tells you how many times would my current assets pay my current liabilities. So if I get 1.5, then that means I could pay my liabilities with my current assets, my current liabilities with my current assets 1.5 times. If I get 2.5, I could pay them 2.5 times. If I get 10, I might have too much money sitting there in cash. Maybe I need to invest some of that. And you could do that in your own finances as well. So here's a little example. If we've got current assets of 128 billion and current liabilities of 100 billion, when we subtract one from the other, we still have 27 billion left. Wow, wouldn't you like to have $27 billion left over when you pay your current liabilities? If you want to find the current ratio, you're going to take the current assets divided by the current liabilities. We get 1.28. So we could pay all of our liabilities, our current liabilities, 1.28 times with our current assets. All right, so let's see, another one for liquidity, we have the acid test ratio. This could also be called the quick ratio. This is the same thing as the current ratio, but it is really looking at your very short-term assets. So it's cash, short-term investments, and current receivables. What's the main thing we left out here from our current assets? The main thing is going to be our inventory. They say, hey, we want to know what can really quickly be turned to cash. Liquid is things that can very quickly be turned to cash. So for the acid test ratio, or again, it could be called the quick ratio, we're leaving inventory out. We divide that by all of our current liabilities, and that gives us the acid test ratio. So for here, we add up all of these, the cash, the short-term securities or investments, and the current receivables. That gives us total quick assets of 92,000 or 92 billion actually, and we divide it by the current liabilities. So if we had to pay all of our current liabilities without inventory, basically, we could almost pay them. We got 0.91, so we could almost completely pay them with just these 3 current assets. So that's what that's looking at. All right, so let's look at this one here. So it says we've got our current ratio, our acid test ratio, our accounts receivable turnover, our inventory turnover. We have 2 different companies we can compare. So first it says, based on the current ratio and acid test ratio, which company appears better positioned to pay their current liabilities? Okay, so according to the current ratio and acid test ratio, which one of these 2 companies can better pay their liabilities? All right, Parker, right? They can pay theirs over 3 times, where Morgan, they are going to be able to pay all of them, but it's 2 or 1.5 times. All right, based on the accounts receivable turnover, which company converts its receivables into cash more frequently? So we're going to look at these ratios in a minute, but we'll go ahead and cover these. So which converts their receivables into cash more frequently? So the accounts receivable ratio is how many times did we take our receivables where customers owe us and we actually receive the cash from that. So Morgan did that 31 times in a year, basically, and Parker did it 17 times. So Morgan was able to turn their accounts receivable over faster. Customers owed them, customers paid them quicker than Parker Company did. And then on the inventory turnover, same idea. How many times do we buy inventory? How many times do we actually sell that inventory in the year that we bought? Which one appears to hold inventory for the least amount of time? So to give you an example here, if I had a bunch of big screen TVs and there was some kind of specialty big screen TV, I probably would not sell them over and over and over and over and over again throughout the year. Where if I'm selling a bar of soap, if I'm selling a bunch of Dove soap, I'm probably going to be selling all of my inventory pretty often, pretty quickly. So that's what we're looking at here. The higher the number is, the more times our inventory is sold throughout the year, the more times we wipe out all of our inventory. So Morgan would sell that more often. All right, that was liquidity. This one is efficiency. So for efficiency, we'll look at the ratios. We just talked about what the accounts receivable ratio turnover is. That is our net sales divided by the average accounts receivable. The trick here is to get the average accounts receivable is to take the beginning, so usually January 1 accounts receivable, plus the ending, December 31st, and divide them by 2. That will give you what the average was in accounts receivable. So again, that's how many times customers get your credit and then pay for it. So you turn that over. Inventory turnover, we just talked about as well. That's the cost of goods sold divided by average inventory. So just like the average accounts receivable, we take the beginning inventory number plus the ending divided by 2. Then our total asset turnover, we're going to take our net sales divided by our average total assets. So we're kind of seeing how well are we actually making sales off of the assets that we have. Do we just put all of our cash in a piggy bank, or do we use that to buy equipment that helps us to make more sales, or do we invest it to help us to have more revenue or whatever? All right, solvency. Here we're going to get into longer term debt. So the first one is going to be debt to equity ratio. We have our total liabilities, not just current, divided by the total equity. So basically, we have a lot of assets, but how much of that's liabilities, how much of it's equity? This will tell us that. So here, if we have total liabilities, 241 billion, we divide it by total equity of 134, and that would tell us the debt to equity ratio. So 64% of our assets is tied up in liabilities, 35% is tied up, 36% almost tied up in equity. So when we take the total liabilities divided by the total equity, we get 1.8. So our liabilities, we have 1.8 times as many liabilities as we do in equity. All right, then we get to profitability. We're almost finished. Thank you for sticking with me in this. Almost done. We get to the profitability, how much money we've making. We're going to take our net income, that bottom number on the income statement after we've paid all of our expenses, divided by net sales. We already looked at that on our common size or our vertical analysis. We took our net income divided by our net sales. That gives us our profit margin. Then the return on total assets, again, we take that bottom number, the net income, how much we're actually making at the end of the day, divided by our average total assets. That helps us to see, for all the assets that we have out there, how much are we actually bringing in net income after we paid all our expenses. The last thing we have here is our market prospects. Here we're going to start looking at, the shareholders. What are they looking at us as? Are they seeing us as people they want to invest in? So first we see our price earnings ratio. This measures the market expectations for future growth. If we have a higher price earnings ratio, that means our investors are expecting us to grow. So we take the market price per common share, how much it's selling for on the stock market, divided by the earnings per share. And our last one of this chapter 13 is dividend yield. This is basically going to be kind of like the interest that you earn. If you think about dividends as almost like interest you earn. I mean, overall, the reason that you buy stock is because you want it to grow and you can sell it at a higher amount. But a bonus is the dividends you get. So a dividend yield is almost like saying, hey, what kind of percentage did I get back on my investment? So that's your annual cash dividends per share divided by the market price per share. And that percentage will kind of tell you how much you earned while still holding on to that stock. All right, I hope you learned a lot in this. I know we covered a lot in a short amount of time. Please reach out with questions that you have, and I'll look forward to going over chapter 14 with you very soon.